House prices in the UK have gone up more than 70% in the last 10 years. But here's the scary part. Wages haven't kept up. Most people are earning about the same, while homes are now way more expensive. And now things are starting to change fast. Last month, mortgage approvals hit one of the lowest levels since the 2008 crash. Interest rates are rising, bills are going up, people are struggling to buy homes, and some experts are starting to ask, is the UK housing market about to crash? For years, we've been told that buying a home is one of the smartest things you can do, that prices always go up. But what if that's no longer true? What if we're about to see a big fall in house prices, a crash that could affect millions of people? In this video, we'll show you 10 big reasons why the UK housing market could crash very soon. These are based on real numbers, expert warnings, and things already happening right now. And trust me, reason number 10 is the most surprising of all. Most people don't see it coming. If you're thinking about buying, selling, or just want to know what's really going on, this video is for you. What you'll learn today might just change your next big move. Let's get started. Number 1. Soaring interest rates. Let's start with something that's already hitting buyers hard. Interest rates. Just a couple of years ago, you could get a mortgage with an interest rate as low as 1.5%. Fast forward to now, some new mortgage deals are going above 5%, even 6%. That might not sound like much, but it makes a huge difference to monthly payments. For example, if you borrowed £250,000, a 2% interest rate means you'd pay about £1,000 per month. But at 6%, that jumps to over £1,600 a month. That's £7,000 extra per year, just on interest. So what does that mean for the housing market? Simple. Fewer people can afford to buy. And the ones who do qualify for a mortgage are borrowing less. When people can't borrow as much, they can't offer high prices. And when that happens, house prices start to fall. Banks are also becoming more cautious. They're tightening lending rules, making it even harder for buyers to get approved. This is the same pattern we saw before the 2008 crash: higher interest rates, fewer buyers, and falling prices. And the worst part? The Bank of England has hinted that rates could stay high for longer to keep inflation down. That means we're not just seeing a short-term bump. This could be a long, painful squeeze. Bottom line? Soaring interest rates are already cooling the market, and they could be the first domino to fall in a much bigger crash. Number 2. Mortgage affordability crisis. Even if someone wants to buy a home right now, the truth is, many simply can't afford to. With house prices still high and mortgage rates rising, monthly payments are becoming way too expensive for the average buyer. Banks are also tightening their rules, meaning it's harder than ever to get approved for a mortgage, especially for first-time buyers. In fact, according to recent data, mortgage approvals in the UK have dropped to their lowest levels in over a decade. That means fewer people are being allowed to borrow money to buy a home. Let's break this down. Imagine someone earning £30,000 a year. A few years ago, that might have been enough to borrow £150,000 to £180,000 with a low interest rate. But today, with higher interest rates and stricter rules, they might only get approved for £100,000 or less. And let's be honest, what kind of home can you get for that amount in today's market? This is a huge problem for the housing market. If buyers can't afford homes or can't get approved for loans, demand drops fast. And when there's less demand, prices start falling. Worse still, people who bought recently with low rates may struggle to remortgage when their deals expire. If their new payments are too high, we could see a rise in forced sales, which would flood the market with homes and drive prices down even more. In short, the mortgage affordability crisis isn't just stopping people from buying, it's slowly draining the life out of the housing market. Number 3. Falling real wages. Here's a fact that's not getting enough attention. Most people in the UK are earning less now than they were a few years ago. once you factor in inflation. This is what economists call falling real wages. Your paycheck might look the same or even slightly higher, but because the cost of living has gone up so much, you can actually buy less with your money than before. Energy bills, food prices, fuel, everything is more expensive. So even though house prices are still high, buyers have less money left over each month to put toward a mortgage. And it's not just first-time buyers. Even people looking to upgrade or move house are feeling the pinch. With less disposable income, they're holding back. Many are choosing to delay buying, hoping the market will cool down or prices will drop. Here's the problem. When fewer people are willing or able to buy, the housing market slows down. Sellers get nervous. Some cut their prices. Others pull their homes off the market entirely. And just like that, the momentum shifts from a seller's market to a buyer's market. And eventually, possibly, into a full-blown housing downturn. The Office for National Statistics recently reported that real wages in the UK dropped by more than 3% in a single year. That's the biggest drop in over a decade. Bottom line, when people can't afford to spend, the housing market suffers. Falling real wages are like a slow leak in a balloon. They might not pop it instantly, but given enough time, the whole thing starts to deflate. Number 4. Overvalued property prices. Let's face it, UK house prices are seriously overvalued. In many areas, homes now cost 10 to 12 times the average local salary. That's way above the long-term average, which sits around 4 to 5 times income. This huge gap is a major red flag for economists, who see it as a classic sign of a housing bubble. Think about it. If most people can't afford the homes in their area, who's going to keep buying? At some point, the demand has to drop, and when it does, prices usually follow. It's not just about earnings either. Many buyers in recent years were only able to afford homes because of super low interest rates. But those days are gone. Now that borrowing is more expensive, those same prices don't make sense anymore. We're already seeing this in some parts of the UK. Places like London, the South East, and parts of the Midlands are reporting price drops and longer selling times. Homes are sitting on the market for weeks or even months without offers. And when sellers get desperate, what do? They lower their asking price, multiply that across the country, and you've got the start of a serious downturn. Many experts believe the UK housing market has been propped up by debt, cheap credit, and blind optimism. But when those props are removed, the true value of homes comes into question. Bottom line, if house prices are far above what people can realistically afford, they're not sustainable. And when reality catches up, it can hit hard and fast. Number 5. Rising unemployment risk. One of the biggest threats to the housing market right now is something many people are starting to feel uneasy about: job security. The UK economy has been slowing down, and with it comes a rising risk of unemployment. Businesses are cutting costs, some companies are freezing hiring, and others are already starting to lay people off, especially in industries like retail, tech, and construction. Why does this matter for the housing market? It's simple. When people lose their jobs, they often can't afford their mortgages. Missed payments can lead to repossession, and repossessed homes usually get sold quickly and for less. That floods the market with cheaper homes, which pulls down prices for everyone. It also shakes confidence. People who are worried about losing their income aren't going to rush into buying a house. In fact, they're more likely to put off big decisions, delay moving, or stay in rented properties until things feel safer. And remember, confidence is everything in the housing market. Once buyers start to worry, demand drops fast. When that happens, sellers have to compete harder, often by lowering their prices. In a worst-case scenario, rising unemployment could create a chain reaction: less income, more defaults, more forced sales, and falling house prices. It's happened before. Just look at the 2008 crash. According to recent forecasts, the UK could see a significant rise in unemployment if the economy doesn't pick up soon, And that's something the housing market is not ready for. Bottom line, a shaky job market means fewer buyers, more risk, and a very real chance that the housing market could take a serious hit. If you found this video helpful, drop a comment and tell us which reason shocked you the most. We read every single one because your thoughts truly matter. We put a lot of effort into making videos like this, so if you want more eye-opening content, hit that subscribe button. It's just one click, but it means the world to us. Number 6. Declining foreign investment. For years, foreign investors, especially from countries like China, the US and the Middle East, have poured money into the UK housing market. London, in particular, became a global hotspot for overseas buyers snapping up luxury flats and investment properties. But now, that tide is starting to turn. According to recent data, foreign investment in UK real estate has dropped by more than 25% in the last year. And it's not just about high-end London homes. This shift is impacting cities across the country, from Manchester to Birmingham. Why does this matter? Foreign investors often buy properties in bulk, sometimes even off-plan, before they're built. They've been a huge force keeping demand and prices high. When they pull back, it creates a massive hole in the market that's hard to fill. Several reasons are behind this change. Higher interest rates make returns less attractive. Stricter UK tax rules on foreign-owned property. Political uncertainty and economic instability after Brexit and other policy changes. And of course, better opportunities in other countries offering stronger returns. With fewer international buyers in the game, more homes are left unsold, especially in the luxury and city apartment sectors. That puts downward pressure on prices, and developers may have to slash prices to move stock. And when the top end of the market falls, it often drags everything else down with it. Bottom line, when big money pulls out, it's a clear sign that confidence is falling, and that's never good news for a fragile market. Number 7. Rental market strains. There's a big shift happening behind the scenes in the UK housing market, and it's coming from the rental sector. More and more landlords are selling up and getting out of the market. Why? Because being a landlord in the UK is getting harder and a lot less profitable. Let's break it down. Rising interest rates mean higher mortgage payments for landlords with buy-to-let properties. At the same time, new tax rules have reduced the amount they can claim back, cutting into their profits. And with the government introducing stricter regulations on energy efficiency, safety standards, and tenant rights, many landlords feel it's just not worth the hassle anymore. According to surveys, nearly 1 in 10 landlords plan to sell at least one property in the next year. That might not sound like a lot, but if thousands of rental homes suddenly hit the market, it could flood the supply, pushing house prices down. On the flip side, renters are feeling the squeeze too. As supply falls, rents are rising, and many tenants are struggling to keep up. But for buyers, this creates a strange situation: high rent, expensive homes, and very few good options. This chaos in the rental market is making everyone nervous. And when landlords leave in large numbers, it's usually a sign that the market is reaching a breaking point. Bottom line, the UK rental market is under serious pressure, and if landlords keep leaving, it could trigger a wave of selling that sends house prices tumbling. Number 8. Construction boom. You might think that building more homes is a good thing, and in the long run, it is. But when too many homes are built too quickly, especially when demand is falling, it can lead to a dangerous problem: oversupply. Right now, the UK is seeing a construction surge in certain areas. Large housing developments, high-rise flats and suburban estates are popping up everywhere. Builders are racing to finish projects started when the market was booming. But here's the problem: who's going to buy all of them? With mortgage rates up, wages down and buyer confidence shaken, many of these new homes risk sitting empty. And when supply outpaces demand, sellers and developers start cutting prices to attract buyers. That can quickly trigger a chain reaction, dragging down prices across the board, even for existing homes. This isn't just theory, it's happened before. After the 2008 crash, entire developments in parts of the UK turned into ghost towns. Half-built homes, unsold flats and empty streets. Builders pulled out, prices collapsed, and we may be heading there again. Some developers are already offering discounts, free upgrades, or even paying part of buyers' deposits. Clear signs that demand is cooling off fast. If too many of these new homes go unsold, it could create serious problems for both the housing market and the wider economy. Bottom line, building too much too fast in a slowing market is like adding weight to a cracking bridge. It might hold for a bit, but eventually something's going to give. Political and tax uncertainty. A market that can't trust the rules. If there's one thing that scares investors and home buyers, it's uncertainty. And right now, the UK housing market is full of it. Over the past few years, we've seen frequent changes to property tax laws, shifting government policies, and sudden announcements that send shockwaves through the market. Remember the 2022 mini-budget disaster? In just a few days, interest rates spiked, mortgage deals were pulled, and the market panicked. Events like that don't just cause short-term damage, they shake long-term confidence. Buyers and investors need stability. They need to know what kind of tax they'll pay, how the laws work, and whether they'll get a return on their investment. But with talks of stamp duty reform changing capital gains, tax rules for landlords, and housing policy U-turns, people don't know what to expect anymore. Even small changes can have a big impact. For example, when the government removed tax relief for landlords, thousands began selling off their properties. When the rules around second homes shifted, so did buyer behavior. And it's not just about taxes. There's growing tension between national housing targets and local resistance to new builds. One year, the government promises more homes. The next year, councils block developments. It's a back and forth that leaves the market confused and unstable. Bottom line, a market that can't rely on consistent, fair rules is a market that's walking on thin ice. And if buyers and investors start losing faith in the system, they'll pull back, leaving prices to fall, and fast. Number 9. Political and tax uncertainty. If there's one thing that scares investors and home buyers, it's uncertainty. And right now, the UK housing market is full of it. Over the past few years, we've seen frequent changes to property tax laws, shifting government policies, and sudden announcements that send shockwaves through the market. Remember the 2022 mini-budget disaster? In just a few days, interest rates spiked, mortgage deals were pulled, and the market panicked. Events like that don't just cause short-term damage, they shake long-term confidence. Buyers and investors need stability. They need to know what kind of tax they'll pay, how the laws work, and whether they'll get a return on their investment. But with talks of stamp duty reform changing capital gains tax rules for landlords and housing policy U-turns, people don't know what to expect anymore. Even small changes can have a big impact. For example, when the government removed tax relief for landlords, thousands began selling off their properties. When the rules around second homes shifted, so did buyer behavior. And it's not just about taxes. There's growing tension between national housing targets and local resistance to new builds. One year, the government promises more homes. The next year, councils block developments. It's a back and forth that leaves the market confused and unstable. Bottom line, a market that can't rely on consistent, fair rules is a market that's walking on thin ice. And if buyers and investors start losing faith in the system, they'll pull back, leaving prices to fall, and fast. Number 10. Consumer sentiment collapse. Out of all the reasons we've covered, this one might be the most important and the most dangerous. The power of fear. You see, the housing market isn't just about numbers, mortgages, or interest rates. It's also about how people feel. And right now, people are scared. With constant headlines about price drops, rising costs, job losses, and economic uncertainty, Buyers and sellers are starting to lose confidence. And when confidence drops in the housing market, it's like someone slamming on the brakes. Even if someone can afford to buy, they may hold off. What if prices fall next month? Sellers do the same. What if I wait too long and can't get the price I want? This creates a kind of market freeze where people wait, worry, and second-guess every move. And here's where it gets dangerous. When enough people believe the market is going to crash, they cause the crash. That's the scary part about sentiment. It's a self-fulfilling prophecy. If buyers pull out and sellers panic, prices start to drop. Once prices drop, more people panic, and the cycle continues. This is exactly what we saw in 2008, and we're seeing early signs of it again now. Rightmove recently reported a 15% drop in buyer inquiries year over year, a strong hint that people are sitting on the sidelines, waiting for something to break. Bottom line? Even with strong fundamentals, a shift in public mood can crash a market. And right now, that mood is turning cold, fast. So, after looking at all 10 warning signs, one thing is clear. The UK housing market isn't just cooling off, it's showing real cracks that could lead to a full-blown crash. We've got soaring interest rates, fewer mortgage approvals, and households struggling to keep up with everyday costs. Add in overvalued homes, a wave of landlords selling off, political confusion, and declining foreign investment, and you've got a perfect storm. And the most powerful piece? Consumer confidence is collapsing. People are scared to buy, scared to sell, and unsure of what's coming next. But here's the truth. This doesn't mean everyone is doomed. In every downturn, there are winners and losers. Some people will be stuck with negative equity. Others will spot opportunities as prices fall. It all depends on how prepared and informed you are. If you're thinking of buying, selling, or investing, now is the time to pay close attention. Don't get caught up in hype. Don't make decisions based on fear either. Instead, focus on the facts, stay updated, and be ready to move smart, not fast. Because whether the crash happens tomorrow, next month, or slowly over the next year, one thing is certain: the signs are already here. So what do you think? Are we heading for a correction or something much worse? We'd love to hear from you. Do you think a crash is coming, or is this just another false alarm? Drop your thoughts in the comments. We read and reply to as many as we can. If you found value in this, check out our previous video for more eye-opening insights into the UK economy. We put a lot of heart and effort into making these videos, so if you want to support the channel, please hit that subscribe button. It's just one click, but it means the world to us.